Your first degree is a very important degree because that kind of sets you discipline and gives you ideas about how you want to work. So when we say engineering, I have found it very useful in my role as a portfolio manager and CIO because one thing you can do in engineering is that you cannot just create hypothetical scenarios. I mean, these are based on real numbers, real outcomes.
Welcome everyone to a new episode of The Blunt Dollar. Today's guest is none other than Manish Singh, a seasoned global macroeconomist, investment strategist, and portfolio manager with over 18 years of experience navigating the complexities of multi-asset investing.
Having a framework of making decisions and a process that helps you a lot. To me, engineering background gives me that.
I'm curious, going back to your engineering background, what made you pivot?
So the answer is very simple.
This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Welcome everyone to a new episode of The Blunt Dollar. Today's guest is none other than Manish Singh, a seasoned global macroeconomist, investment strategist, and portfolio manager with over 18 years of experience navigating the complexities of multi-asset investing. Manish currently leads investment efforts at Crossbridge Capital after a career that spans UBS Investment Bank, Societe Generale, and structured finance roles across London, Hong Kong, and India. Along the way, he's crafted a reputation for balancing disciplined portfolio construction with an opportunistic eye for market dislocations. He's a CFA charter holder, a chemical engineering graduate from IIT Mumbai, and he holds a master's in finance from Cranfield. He's also a frequent voice in global financial media, regularly featured on Bloomberg, CNBC, and ET Now, sharing insights on macroeconomics, geopolitics, and capital markets. In this conversation, we'll dig into how he thinks about investing, his role as a CIO, and how he structures portfolios to survive crises, and why the real edge in investing might not be predicting downsides and recessions, but actually preparing for them. Manish, I'm absolutely excited to have you here on the show. Welcome to The Blunt Dollar.
Thank you, Ignacio. Thank you very much. And I'm very happy to be here and have a chat with you about everything that you mentioned just now.
So let's start with just getting to hear a little bit about what is it that you're doing today. What is your role at Crossbridge Capital, and what are you doing exactly over there?
Yeah, so I'm the CIO at Crossbridge Capital, which means that I have to look at asset allocation, make investments, and of course, most importantly, to drive the direction of the portfolios, how it should be invested. So right from asset allocation to trades, I have a small team that works with me, and we are largely equity investors. So we invest mostly in equity, though we do have some bond positions and some funds as well. But largely, I would say equity investor, mostly devoted to large cap stocks in US and Europe, and our main investment strategy is on structured notes. So we take a view that if you take a medium term approach to investing on stocks, then you have a much better chances of earning your returns than having a very short term strategy. So we like to have a very disciplined medium to long term approach on large cap stocks and a very much top down investing.
Okay. So we're going to be talking a lot about your role as a CIO. I have a lot of questions about that, but maybe before we dig into that, let's take a step back and walk us through your journey. Because you started your career not in finance but in chemical engineering, and I thought that was really interesting about your profile. Yeah. It's kind of an unconventional path for someone who now manages complex portfolios across different asset classes. So how do you think your training as an engineer shaped the way you approach markets and decision making today?
Sure. I mean, I believe that, your first degree is a very important degree because that kind of sets you discipline and gives you ideas about how you want to work. So when we say engineering, I have found it very useful in my role as a portfolio manager and CIO because one thing you do in engineering is that you cannot just create hypothetical scenarios. I mean, these are based on real numbers, real outcome. So you get used to having a very data driven approach to investing. And when you do data, you detach yourself from emotions because you cannot manipulate the data, especially when you're making investment decisions based on that, and it can be very brutal. So what engineering or science background gives you, it gives you a discipline wherein you start understanding that what has to be done, what are the inputs, and what are going to be likely outputs. Now we know investing is not science, investing is art, but having a framework of making decisions and a process that helps you a lot. And to me, engineering background gives me that. So when there's a lot of noise, I have my process and I can stick to my process and rely on that to help me make investments.
I love what you're saying about inputs and outputs. So when I think about engineers, I automatically think about systems. I have the feeling that you guys think about systems all the time, and constraints, feedback loops, and yeah, the alluded inputs and outputs. And I think markets in their own way, they are a giant messy system, right? So
Correct.
would you agree? Like, do you see the market as a system? And if so, how does that lens change the way you interpret them?
So I would say that, so if so my undergrad in engineering helps me that. But what I really learned after engineering, which is why I'm an investment side, is that you really have to have a good knowledge of history. I mean, good knowledge of history and philosophy helps you a lot because ultimately the market participants are not machines. Well, lately maybe a lot of machines, but participants are human beings, and which means that they have their own biases, they have their own issues and problems to deal with, and you are making decisions based on that. So it cannot be completely driven by systematic way. I'm sure the systematic hedge fund guys will disagree with me, but I think that it cannot completely be relied only by using systems. And having that background or understanding of history, economics, and just how people think and how they make decisions becomes extremely vital. So it allows you to marry the two things, take the data, take the process, and then overlay that with understanding of human psychology and how people make decisions and their own biases. And that helps you refine that process. And if you do that for long enough time, you start understanding what works, what doesn't work. So to me,
Mhm.
that is the process that I really always like to champion. And when I'm speaking to my juniors or I'm speaking anywhere, I like to highlight that because that process has to be driven over time and has to change over time and adapt and evolve to a process that works.
You were talking about history. Do you think there's a particular period in history that you found useful to explain what is happening in markets today?
See, I would say that the big events are always the main things to look at. So if you look at yesterday we are having a chat on LinkedIn, and I mentioned is that when people are talking about 100-year bond, they forget that how much things can change in 100 year. I mean, look, it has been 80 years since World War II, and we talk about 100-year bond. Look what that period of the world was and what it is today.
Mhm.
There was 80-year gap between the U.S. Civil War and First World War and how much America had changed. So sometimes when we say 100 years, and then we don't say that in a very light way. Oh, I'm going to buy 100-year bond. But coming back to your question about which period of history informs me, I think the mid 18th century in Europe is very important part. So around 1830 to 1860, where a lot of things happened, like the whole Europe was in upheaval. There was a huge amount of unsettling and revolutionary thing happening everywhere across Austria, Germany, the end of Austro-Hungarian Empire. So I think whenever you have big setups unraveling, that's when you have the biggest change because you just do not know what it's going to throw up. So I try to read more around that and take things from that. Now, of course, that's 200 years ago. So you have to understand that not everything is going to replicate. And we didn't have data, we didn't have computer, people didn't have vote. A lot of things has changed. But you can always draw from that how human behaviors are. I always like to say that the market is full of human participants. They have the same issues and same problems that they had in the past. They might dress differently, but they still have the same thing that they think like and they like to solve problem with. So you can learn from that how humans behave, but it is not going to be exact replication of that. But you know that the panics and fears are going to repeat itself. And just to give you example, when COVID happened in 2020, this is in our lifetime, what we
Mhm.
talked about, I just saw people coming into office and thinking, some saying, 100 million people are going to die, 20 million people are going to die. Me being an engineer or maths background, I said, what's the basis? That was my question. So when I looked around, I said, yeah, I can buy this, viruses can do that, and you had Black Death and all these things. But what's the basis of these conclusions? You do not have any evidence. Science has evolved a lot. A lot of things has happened. So sometimes when you're too much only into the history, you bring the fear part. But when you go into the present and you start understanding how the world has changed and what the world is, then you can dismiss some of that, not entirely, but you can be more prudent. And I saw that firsthand in COVID, how people were reacting, and that was kind of showing people's biases of how they think and how they think about risk in general.
Yeah, and I guess it helped you to stay grounded whilst everyone was panicking.
Correct. Yeah, Ignacio, you're absolutely right. I have a newsletter I wrote around that time, which is still on my website, in which I critiqued some of these models and the predictions that they were making, because I looked at what the same models or the same people had said in the past for various things, and they were entirely wrong. And even though I'm a maths graduate, engineering graduate, I say you just cannot model everything. To rely too much on your model is to set yourself for failure. And I think that in policy terms, we are still making a lot of mistakes where only academic inputs are being used to make decisions, when actually you should have a group where you have 50% practitioners and 50% academic or the quant people. But it cannot be 100% quant and tech. It cannot be 100% practitioners.
And why is it not like that? Why are we not going towards that direction where we add more of the hands-on, on the ground perspective?
I think it just shows how the mix of let's look at central banks. If you look at the U.S. Federal Reserve, if you go down on the website and check people's background and their experiences, you will see that, let's say there are 10 governors, 12 governors. How many of them have really worked in private sector? If you go in the current constituent, probably there are two or three who have worked for 4 or 5 years. Maybe the new Cleveland Fed chair, I forget her name, she has worked a longer at Goldman. So you see that 80-95% of their time has been spent in academic bodies, PhDs, research and all, which is respectable. And it is a lot of hard work to do. But then they are regulating economy, which is real, which is being driven by human beings and people and various other things. And it's my view that over the time, this is the mistake that the world has made, is that it has gone in completely one direction. It has ignored the practitioners. So you don't go and talk to a CEO or bring a CEO on that decision who is running and has 200,000 employees globally to look at and say, should they be really stopping production because COVID has spread? I'm just using COVID as an example, but they're not looking at a CEO and saying, what are your constraints? How are you managing it? They don't have a voice. So you go and get a modeler from Imperial, you get people, and then nobody wants to contradict anyone because nobody wants to take responsibility of something going wrong. So by consensus, you keep driving yourself in the wrong direction for far too long. And that to me is a concern policy wise that I see in central banking, in government, in various other places.
Wow. I love that take. Thanks for that. Hopefully we get more into that direction and we get more practitioners in the future. I think that's the yeah, there has to be some balance. I agree. It wouldn't be good either just to have practitioners and
Absolutely not.
no
Yeah,
academic profile. So I
yeah,
think there has to be an in between
correct.
between both extremes. But so I'm curious, like going back to your engineering background, what made you pivot? Like, I'm trying to imagine Manish, young graduate, spent countless hours sweating to get engineering degrees that are notoriously they're known for being incredibly hard. And instead of working for, I don't know, like a utility company or something like that, you're like, okay, I'm going into finance now,
Yeah,
which was probably very different to what most of your friends in class would do at
sure.
the time. What pushed you to take that decision?
Yeah, so I went to IIT, which is like a premier institute in India. And if you look at the graduates from there, they are everywhere in the US running big companies, big banks, and other places. So it's an incredibly difficult university to get in. So your question is absolutely right that once I have got into that university and got the best education, why did I choose to do something differently? And the answer is very simple. In the second year of my undergrad, I picked up a book on international finance in the library, and I just couldn't put it down. For me, it was like the complete change moment that I wanted to be more, as I said, on the business side, understand how the world works and how things work. And this was, so I did my undergrad from 96 to 2000. So when I was graduating, that was the dot com time, 99, 2000. I remember picking up financial paper in India, reading a headline of one of the analysts just trashing down Amazon and saying that this company will never make money. This company is going to go bankrupt. Look where Amazon is today. Now, of course, I was not a finance graduate then to to comprehend everything. But to me, the excitement of really being at the forefront, I literally mean forefront of knowledge, knowing exactly what is happening. That to me is the most exciting part. So when
Mhm.
I come into office and I see that, oh, China is about to have a chat with the US, you start drawing conclusions. So when I say that I don't use a lot of my model, and even though I did an engineering and maths, I don't use a lot of model and quant. I like to see signals. I see myself as somebody who's trying to complete a picture, and I'm taking signals from everywhere. So when I started, I read international economics book, and I just couldn't put it down. And we didn't have enough electives in finance. Unlike the US universities or Europe where you can change your major, it was chemical engineering that I had to do. But I
Mhm.
made up my mind that I will do and end up doing investment management or whatever it may be. At that time, it was called finance. When I graduated, and this was in 2000, you didn't have international banks coming into India to recruit. And now they go and recruit graduates from these universities, and they have been doing it for the last 10, 15 years. Then I had to do a master's because we didn't have. I mean, at that time in India, when you said a finance or banking job, you meant somebody who is a bank teller or sitting a retail bank. And that was not my idea of investment or finance. My idea was to make investments. And one of the earliest book I read on that was also Barbarians at the Gate
Mhm.
by Henry Kravis. And I should mention that I met Mr. Kravis in New York in September when I was there.
Oh
He's a
wow.
great man, and while I don't count him as my mentor, but I met him a couple of times and we get on well. So for me, it was like a completion of a full circle of coming in and looking at people that you idolize, and you meet and find out how they have developed their career and what they have done. So for me, the human part has always been the most exciting part. So when I see people are making claims about dollar destruction, US, I try to not see just as a trade. I see whether this can happen and what this means for people and other thing. So I always try to tone down the quant part and the other part and bring in the real part in terms of how the world works.
Mhm.
One thing I remember growing up as a child, I would think about that the world has a framework and it works in framework, and people are making decisions based on framework. There is no framework. It has been driven by individuals, which is exactly why you have success or failure. Because if you get a wrong leader, you just go down the wrong direction. If you get told things which you strongly believe without checking any evidence, you get misled. So
Mhm.
to me, that has been like a big learning. So these are the frameworks I look at. Like, everything is very real. It has been driven by people, leader, a portfolio manager can do a good job, bad job. It's not the bank. It's not the bank you work for that gives you return. It's that portfolio manager and that asset manager gives you return. It's the president who makes the policies, prime minister who makes the policies, not the country, not the society. So that was to me was a big thing that I have developed over the last 10 years, that it's being driven by individuals. Either you will have success or big failures if you don't understand an individual and what they're doing. And there's nothing to say US will be great forever or Japan will be or China will be, because it's been driven by individuals who better understand society, cultures, how they work, and what's happening in that society, which is changing.
Right. Very comprehensive answer over there. Um,
Right.
Before my next question, can you step a couple of centimeters back because sometimes you're leaning to the
Okay,
front and your
sure.
face is getting caught on the top. I'll cut this
Oh,
afterwards. Don't worry.
sure.
Um, so you've also worked across different geographies. You worked in India, in London, in Hong Kong, so different major financial hubs. But each of them has a very different cultures and rhythms.
Sure.
What did you learn from working in such different markets and cultures?
So I would say that my major instinct was in London. So when I was in India, I was not doing finance. In Hong Kong, I was at UBS and I was there for 3 months. And I have been traveling to France a lot because when you're in Europe, my first job was in equity research analyst. And at that time, I went all across Europe selling my strategy piece or research piece, to all the asset managers. So yes, that has been a big experience in itself. And what I've really found, I find this about London as a city. Like, London is a unique city in the sense that you find so many people from so many places who come here. I have this joke with my friends in India. I say that, for you guys, when you have to meet someone, you take a flight. I take a cab because that's how long it takes me to meet someone important, international, or in my line of business or anything. And that just allows you to not just network, because network is one part of it, but the second part is really meet people, like-minded people who you want to meet and have a discussion with at a short notice. Now, a good understanding of culture is important, and that allows you to basically cross those cultural barriers and interpret what a yes means, what a no means, what a maybe means. So that becomes really important because people are generally polite. I need to understand when somebody is being polite or somebody means yes, or somebody really is going to make the investment, or on the relationship management side, somebody will become a client, not become a client. So I think knowing these things are very important because by that you can tune, how you're spending your time and effort in developing something. Uh, if somebody doesn't want a certain style of investment, you need to understand that rather than respond to it down the line after 1 year. So I think that has been immensely helpful because ultimately we are in markets and we deal with people, not machines. We deal with people. So the more people you meet from different culture, the more you understand. In fact, if you look at the research analysts, their writings, right? If you understand that what their cultural barriers are, where they come from, you interpret things differently than somebody just saying what the piece is talking about.
I love everything you're saying. I couldn't agree more with London, by the way. It's such a cool city. You have everything at your disposal. Every time I go over there from Switzerland, I'm like, oh my god, there's so many people. This is a very big city. So you're planning to stay there for the foreseeable future, I guess.
Yeah. I have a 5-year-old and 8-year-old, and so I think we are going to be here stay. We call London our home,
Mm.
so I'm not averse to traveling, but this is our home. Yes.
You look very fresh for having two kids at home. How do you do it?
Well, I mean, I have to give credit to my wife. She's great at looking after children as well, and we have some help from my in-laws. So you always have to be grateful to have good in-laws. Spend time with the children and take some of the pressure off you.
Absolutely. So let's talk about your role as a CIO now. Now that we covered your
Sure.
early stages, being a chief investment officer obviously is not only about setting strategies, but it's about making the final calls, especially in hard moments like the ones we discussed, when uncertainty is high, when everyone is panicking, and when the stakes are real. Um, what was the biggest adjustment you had to make when you stepped into the CIO role? And suddenly all these ultimate responsibilities started to land on your desk. Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
So, see, I would say first thing I would say is that you have to have a process. So the more developed your process are, the more comfortable you will be at looking. And the second thing is that you have to learn to say no. And I don't mean saying no to people, but saying no to data, no to analysis, no to emails, no to a lot of research things being thrown at you. I think that you also have to say no to a lot of these things. So those are the big changes, I would say, because so I was an analyst once, so I respect analysts, the time they devote and things they write. But I also know that with time and the longer you are in the business, you know that you have set up your own process and you need to follow that. So I do a lot of research myself. I like to listen to a central banker when they're speaking because I value body language a lot. You can look at a person's body language and see whether they are saying that thing with conviction or are they going to flip. So when you listen to the policymakers, to the key decision makers, to the CEOs, and listen to the interview in person rather than an interpretation of that in a financial media or an analyst report, then I think it's a very different thing. But where I think research also becomes very handy, you're not going to keep creating your own Excel model, putting up data from quarterly reports. So it's very valuable. But I think the key thing as a CIO or any senior investment professional is that majority of the work you have to still do yourself.
Mhm.
Don't think of yourself as a manager. I just don't like this whole manager thing. You should be. It's a bit like when you got a calculator. You should be able to do the maths using a pencil, paper and pencil and eraser. I think that's very vital. So you don't give up what you were doing. It's just that you adapt your process. You are still looking at all the data, following up everything. Your just decision making has improved. You look at this thing and think 80% is noise. Earlier, probably you thought 80% was information. Now you see 80% is noise. So those are the big changes that happens over time, and I think you need that because you will have a lot of people asking a lot of things to be done, a lot of things to be traded, and you don't have to trade everything.
So talking about noise, I want to ask you about building conviction. because obviously, you
Sure.
have to take decisions that rarely come with perfect information, and you have to build conviction, right? It's not something you're given. You have to go to
Build it.
construct it. So to build it, exactly. So how do you personally build this conviction in a world where data is very often so messy and the future is so uncertain?
So let's look asset class. That's one reason why I'm not doing a lot of other asset classes. So I concentrate on what I can do and what my bandwidth allows me to do. So even though I do mostly equity, I follow all the macro data. You cannot be an equity portfolio manager and not understand rates and fixed income and everything else commodity that's going on, because everything these days, particularly, everything is macro, as you have seen how things are trading. So you have to have that bandwidth, but then choose what you want to do and what you can do in the time that is given to you, that is allowed to you. So I'm not going to sit there and manage duration risk myself and start hedging. That's another job to do. So we might be using a hedged bond or a hedge fund to use that. But things that I'm looking to do, equity, which is what our main strategy is, that I would do myself. In that, how do you build conviction? You build conviction over time based on evidence. That's number one. So there's no shortcut to being a good investment manager. You have to do the time and you have to take the feedback and learn from it, develop. So that's the main thing I would say. Also, when I look at large cap stocks, I narrow myself to few names that I have followed for a long time, which I continue to follow, and where I know the data a lot, and I can just look at quarterly report and make my decisions based on that. And the most important thing for me when it comes to investment is, what is your time duration? Time duration to me drives a lot of return. Let
What
me
do you
tell
mean
you.
by time duration?
Yeah, let me describe what it is, right? So I always look at everything that when I'm putting a trade on, I like to see that this trade I could hold on for 2 to 5 years. I'm not looking at doing it, which is where the leverage part comes in, that I don't like to use. I don't like to use leverage. So when I put a trade on, I don't take a 1 month or 2 month view on anything. I like to say that, is this going to be a good trade for me if I were to hold this for 12 or 18 months? So if I come with a view that recession is happening in 2 months' time, I'm not long the market. I'm not waiting for 1 week before the recession starts to do anything. So my thinking process is more like I'm looking at medium term. And the reason I use duration, as I mentioned, is that when I construct a trade, and this is what I do on basket of stocks or indices, what I like to do is that I don't know what's going to happen over next 4 or 5 years. I still don't know what's going to happen over next 4 to 5 years. So the reason I give myself a duration is that, should something go wrong over next 12 months, 18 months, or 2 years, how am I going to come out of that, and how am I going to come out with keeping my capital intact? So by that, I give myself a duration. So when I create a structured note or bond, I take a 5-year duration. The idea is not to hold that for 5 years. The idea is to give me that safety net for 5 years, so I can still make my capital back and I return back. But that trade could get over in 6 months' time, 18 months, 2 months' time. But I'm not putting a 1 year trade, 6 months trade. But those are very short term trade, because you define maturity. Okay, this has to happen in 6 months' time, where I have no certainty whether it's going to happen or not. So I like to have duration to manage risk, and the certainty comes from choosing the stocks that you know and overlaying the macro view. Is the equity going to go higher, and how things are going to perform?
So, wow, that's a very very comprehensive answer. Once again, thanks for all that color. I'm sure our listeners are gonna really appreciate all those insights coming from a CIO's brain. Uh, you've touched upon many different things, but something I'd like to come back to is yeah, frameworks, and actually the role of philosophy and the influences it has on your role as a CIO. We touched very briefly history, but you also said that you're looking at philosophy very, very closely as a tool to understand markets and to avoid being tossed around by headlines and fear and things like that. So, what core investment philosophy or framework from philosophy helps you when everything feels a little bit unstable?
Sure. I'll give you an example, an incident from my childhood. So my mom, who I just love and respect so much, and she has shaped so much of my thinking. When I was a kid or a student, she would always tell me that, "Oh, Manish, you have exam tomorrow. Why are you not reading?" And the night before, I would never read, because I would have done my reading before. And she would still not believe me. She would say, "No, but you have an exam. You should read tomorrow." I said, no, mommy, I have an exam, but I finished my reading. And I would read my newspaper at that time. And then she would say, I'm going to put all this newspaper away for you for 2 weeks of your exam, and you can read it after 2 weeks of my exam. So she just couldn't trust and believe that I've done my work. So that is a very strong philosophy in me, that a lot of people will not trust and believe what you say. But that doesn't mean you give that up. You still have to use that philosophy to do your homework, not to justify to anyone, not to show to anyone that you have done your work, but you're doing that work because you do it for yourself. You're not doing it to show your mom or show anyone, mom in my case, but not to show anyone, because a lot of people are not going to just trust you implicitly. But when you give them evidence, when you give them example, when you give them that this is what has happened, then they understand and they trust. So that is something that trust has to be built. You can't buy it immediately. You can't get it immediately. And with that, my second philosophy, which is very important, patience. Patience is extremely important. I want to run this as an independent fund and raise money on that. And I could do all that. But I still have to be patient, because if I get a wrong investor, wrong initial investors to work on that, who do not understand how these investments work, then it doesn't work. So one thing I am always is, I'm never in a rush. I'm never in a hurry. I am very confident about what I do because I build that as a process, and I have the patience to develop that, because that gives you a satisfaction that is coming from within, not from outside. When you're seeking satisfaction and approval from outside, you make mistakes. You rush. You do a lot of things that you shouldn't do, and that doesn't allow you success. And the same thing happens on stock picking and trade. People ask you to sell, market is selling, but you're not listening to things that you have developed, which is evidence based over time. And you should listen to that, not just listen, but hone and develop it. Because it doesn't mean you'll be right all the time, but you learn from things and make the process better. So to me, patience and trust, I mean, these are the philosophies that I follow a lot. I don't expect anyone to trust me. So I do my own homework, but I know that with evidence, people trust you, and then they trust you like nothing. And they will always trust you because you develop that. And that's my philosophy, how I look at investment and life, I would say.
So you were talking about mistakes, because even like being patient and trusting yourself and so on, like even the best investors make mistakes. So how do you personally process mistakes or wrong calls, and what's your approach to learn without losing confidence?
Sure. So one thing I always say is that, again, understand the market structure. You will, the sizing your trade. So the size of your trade in your portfolio is very important. Even if you have the highest conviction on a trade, you cannot supersize that trade, because that can really destroy the whole portfolio, right? You could have the returns can completely go everywhere and you could lose your money. So the size of your trade and sizing of your trade is very important. So that's one way of how you manage risk. Now, as far as how do you learn from your mistake, which is again very vital. The only way you can learn from a mistake is to acknowledge, number one, acknowledge that you made a mistake and don't blame it on someone else. So take responsibility. I think take full responsibility. Even if somebody else in the team didn't look, it doesn't matter. You are the head of the team. You have to take responsibility. You have to take ownership. I think that's the first stage of that you can do. Of course, that could have happened because the market moved. Let's say you have an oil trade. Oil trade goes negative. You know, oil cannot be negative, but it happened. It happened 4 years ago. And if you have an oil trade and oil not over there, the losses are going to happen. Now, you can't blame that on anyone. You know that market structure. So there are things that are going to happen in the market. First is always is to take responsibility from that. Keep your trading sizes or your the I don't like to use the word diversification, because sometimes you can diversify returns away, not just risk. But in terms of sizing of your portfolio, don't get super confident that something is the best trade and you're just going to make money on that. So again, those are psychological. So even when I feel confident about something, I always have to bear in mind that overconfidence and having big size on a trade can really be very damaging. So you learn from that. But these are natural ways of how you can balance the risk in your portfolios, and which is something I would do regardless, because it's just good discipline, in my opinion. So you have a process, but you have to have a good discipline, which takes care of these other moves that can happen in the market.
So you've mentioned balancing risk several times there. I'm curious to hear, as a CIO, how do you find risk, especially in the context of a relatively long-term investor as you are?
Sure. So my absolutely good question, Ignacio, because what happens is that when I am looking at risk. I'm looking at permanent loss of capital. To me, risk is permanent loss of capital. I'm not as much worried about mark to market because the assets that I'm holding are large cap assets. I am taking a bankruptcy risk on that stocks can go to zero, which I'm happy to take on large cap names, of names that I have followed, names that have existed for a long time. You see quarterly earnings and all. So to me, loss is defined as permanent loss of capital. The second, it's very natural to be bearish. 95% of commentary and people around you are bearish all the time on media and everywhere. You know why? Because there is a great asymmetry. When these bearish people are wrong, you don't feel unnerved because they have been wrong and the market has gone up. So you feel a joy and happiness. So you forget about the bears. And when the bears are right and market has gone down, you say, oh my God, we lost some money. So you start giving credit to the bears. So there's a natural asymmetry that you will always be surrounded with bearish community and bearish commentary because that sells. That sells. And when they're wrong, nobody talks to them, nobody bothers because everyone is happy making money in the stock market. So you will always be surrounded with bearish commentary. This another very important thing to bear in mind. If I have 10 trades, let's say, and I put $1 on each 10 trade, and if I lost on 5, the maximum you can lose if you're not using leverage is $5. Of the 5 trade, if one of them goes up 3 times, some goes 5 times, 6 times, I have more than made up for my losses. People forget that the maximum you can lose on anything is 100, but there's no cap to what you can make on the upside. So if you bear this in mind, then you will suddenly realize that your positives far outweigh some of the negatives that you may have had in your portfolio. So long as you haven't put like 2 stocks in your portfolio and one is 50, other is 50, then that's a different scenario. So having that discipline and understanding that the maximum capital you can lose on a name is that capital, while on the others you can go many times over, that allows you to keep that in the focus when things are going haywire. I don't like to use leverage because leverage is where things go wrong. If you've used leverage and your trading position is cut. Take an example what happened 3-4 years ago in 2021 when you had the semiconductor stocks going through the roof, and then 2022 you had Nasdaq down 33%. All the semiconductor chips got cut into half, 50-60% down. What happened? If you had a process where you didn't have the mark to market scenario to deal with, which I didn't have because I had a 5-year note structure and there was no risk scenario, I held that note through. If you are a single line equity holder sitting there, stock is down 20%, stock is down 30%, stock is 40%. How long do you hold on to your thesis? Because you are making a lot of decisions every day. I don't like to make a lot of decisions every day. For me, I would like to read. I like to read and I like to look at the data, but I don't have to make trading decisions every day. And to me, my strategy allows me to get rid of all these numerous decisions that a lot of people make every day. And when you do that, you end up making wrong decisions, and that starts hurting you on the portfolio side. So over time, I have realized that the fewer decisions you make, the better you do. But how to make money if the market was completely flat over 5 years? Because you could have a long-term horizon, but market does nothing. How do you make money? And that's when the carry comes in. So you have to create structures that pays you for holding those things. So in my case, when I create a structured note, I am selling an option, and that allows me to make this carry per annum, and that allows me to make returns even if the market is flat. And by choosing a deep protection barrier, I'm taking that safety that I don't have to worry about if the stock is down from the time I've launched it in 2 months, 3 months. Some of these are very technical, but I think that carry structures allows you to benefit from protection. I like to say what I do is the private equity equivalent of a listed market. Because in private equity, you take long-term structures and you create, and therefore you allow the assets to perform. In my case, I use long-term structure to make the equities perform. But unlike private equity, where you're logged in for 10 years, you're not logged in what I do because ours is liquid. You can have daily liquidity. So, but it's the same mentality that you have to choose an asset and give it time to perform because the dividends build up, the buybacks build up, the earnings build up, and that allows you. But if you start judging everything based on quarterly earnings and not based on what the business does, then you have a problem. When somebody asked me, how do you make investment? I said that I'm not like a value or growth guy because I think that growth becomes value down the line. I mean, if you If you look at 1920s, the railroad companies were the growth companies then. They became value companies down the line. Telecom companies were growth companies. They became value companies down the line. So everything become growth and value, and things get muddy. As long as you're not managing a value only portfolio, growth only portfolio, you have the liberty and freedom like I have to invest in things that I believe in. I just look around you and see what people are using. What does the world need? How long do they need it for? What is going to happen? And just buy those things, companies that are making those things, or they are in that business. And that's how, in my opinion, investment should be driven, because that's what the world is using. So I always like to say, look around you, travel, look around you and see what people want, what companies are making it. And you need only a handful of companies to build a portfolio. You look people like Bill Ackman who have built a $20 billion business on 20 names, like what they have done. So I think diversification is good, but if you don't know what you are diversifying into, you could actually be adding risk to your portfolio. If you know what you hold in your portfolio, you could be adding returns to it.
So talking about like giving time to perform that you were talking about, I think, and coming back also to the human side of investing, maybe I think, particularly for long term investors, you need a strange mix sometimes between humility to venture into the unknown and confidence in your process, as you said before. I want to hear, how do you personally balance as a CIO these two things, humility and confidence, especially when things are not going your way? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Yeah. So what I would say, that what really bothers me, if it was to happen in a negative way, I always look at this, that this is the world we live in. What is this world? And how, I mean, I am not trying to find the end of this world, but what I really believe in is that as long as the humanity is surviving and nothing is happening to humanity, a lot of things that we have done will continue to happen. So where I would really get bearish, and you will not see me bearish most of the time in my comments, is that if somebody was to tell me that the population is going to decrease by 20%, 30%, or something is going to happen, to me that is an extremely bearish signal. It is bearish, and I would redefine it. I would say it's an extremely deflationary signal, because the consumption goes down. Your asset prices value cannot hold up because there is no replacement value. You know, liquidity, which is the other thing we should talk about. Liquidity is the biggest driver of asset prices. The reason here I'm sitting in Mayfair and I live in Chelsea and the property prices continue to hold, whereas in the rest of the UK it doesn't hold, is because people want that asset. Same thing happens to stock. So yes, the world can fall apart, but there are few stocks people want, that they continue to want, and they will and that's what one has to figure out. So my humility comes from spending a lot of time figuring it out, what things are, and not having too many holdings in my portfolio. If you have too many holdings in your portfolio, you just cannot do justice. It's like you cannot say I have 10 best friends. Nobody can have 10 best friends. Life doesn't work like that. You have to have two or three who you spend time with. You cannot have 20 best stocks in your portfolio. It doesn't work like that. So it's same thing I apply to what you apply to life, that if you don't spend time with someone, they're not your friend and you can't develop that relationship. Same thing with your stocks. If you have too many stocks in your portfolio and you pick up the next big thing and next big thing, that's just trading. That's not investing. And I have respect for people who trade, but I call myself an investor. I believe in investing and not trading. So when you do trading, you're always panicking because you're using leverage, short-term signal. I need to clip this coupon. I need to make this 2%. And I just completely stay away from that. Because to me, if you can get 10 to 11% per annum over time, you're beating everyone, most of the people in this market, even the ones who are doing 10, 20%. And they're using leverage, which means that you are exposed to those risks. So to me, these are core disciplines that I always follow. I share with my team. I share with clients, other people. I say, life can be very simple. Investing can be very simple. So don't complicate it. But at the same time, have the humility that I can't predict recession. I can't predict COVID. I can't predict some of these things. So I need to have duration on my trades for the trades to perform? Should I get caught in it?
You talked about something that I'm very passionate about, which is liquidity. I'm a fixed income advisor, so obviously it's a topic very close to my heart. I think it's one of those things that are obviously often ignored during bull markets, but during crisis times, it's everything that everyone talks about. So can we spend a little bit of time talking about it? How do you think about liquidity, especially as part of crisis preparation?
So I value that a lot, because I think if you ignore that, so I would say, let's put it two ways. If you believe in your stock and you know that that stock does not have high liquidity, then you have to prepare yourself for mark to market, big mark to market. That doesn't mean your thesis is wrong, but you prepare yourself that oh, those things can be down by 20-25% because people are selling it off. And this is what happens to, let's say, mid cap stock or some other stock. I don't do mid cap and small cap for this reason, because I think there are other risks that comes into it. But even if you're doing large cap stocks, or let's say you're doing bond or any other asset class, investment trust, look at investment trust listed on the UK stock exchanges. A lot of them are trading at big discount to net asset value, because investors are not taking time to understand what's inside these things. So it can work two ways. If you're holding it, it can work against you because you get mark to market. But if you're not holding it, you want to add to it, it works in your favor, because you can buy something which is discounted, market doesn't value. Then you give it the time to perform and the price comes back and you make your return. So I think liquidity can hurt you and help you, so long as you know what you're holding and how much that liquidity is working for you. So when it works for you, you can have assets trading way above your net asset value. I mean, let's talk in terms of PE. You can go to 100 PE. I mean, it's just down to liquidity, not because standing of liquidity is extremely important, because you can then bear some losses and give yourself time. And other times you can sell because you've seen too much of froth and liquidity in that market. You need to get out to reposition yourself if you do such trades. And that can become very handy. And in bonds, if you get into a liquid bond, you can't get out of it, or you can buy something at discount and you can make more than 3, 4, 5 points on it. So I think that those understanding are very vital.
I'd like to ask you also about crisis. Maybe can you share a crisis moment that sticks with you? Like you obviously already mentioned COVID. Do you have other stories or anecdotes that really helped you change the way you think today about managing money?
Sure. I think not directly about managing money, but let me relate. When I was at Sogjan in 2008, when the crisis was happening in the market, I remember the day that Bear Stearns went under. Then you come back and Morgan Stanley is going under. Goldman could go under. I mean, these are things you're not prepared for when you look at, right? So you always come back thinking, oh my God, what is going to happen to this? And I was like my mid or late 20s at that time. And you're thinking about, what can happen? You come back, and my wife, she was in banking as well then. And you come back and say, what is happening to this world? I mean, are these banks going to exist, not exist? And then a month later, you think, well, you're still there, you have a job, and you're doing well. Once you've seen a crisis, which everyone defined as everything is going to end, and it doesn't happen, and you live through it, it gives you a huge amount of confidence. So, crisis is, why are people who let's say, have gone bankrupt a couple of times, are the most confident, successful people? Because once you lose that fear of losing things, once you have seen that and you've survived that, you have confidence like no other. A lot of the time, you stop yourself, not just you and me, I'm talking in that context, but a lot of time people stop themselves from doing things. People stop themselves. Nobody stops them. They stop themselves because of this fear that is lingering in the head all the time. So I always say that this is where it comes back to history as well. When you read history and when you see countries going down, other societies coming up, families going down, families coming up, banks going bankrupt, or businesses going bankrupt, it just tells you that it just continues. I mean, I would say, because I've done physics as well, so I always try to see that what is happening is that, it changes from one form to the other, as they say, because energy can't be created. It just changes from one form to the other. So that if something is getting destroyed, something else is getting created. You just need to look a different place to see where this thing is getting created. So I would say crisis and fear should not be used as a way to take your confidence away. Actually, you should learn from it. You should really understand what that crisis is about, see who were the losers, who were the winners, and
Mhm.
learn from history that there are losers and winners all the time, like stocks in your portfolio, like society.
So I feel like we're turning around a big topic since the beginning of the conversation, that is behavioral finance. We haven't addressed it directly, but obviously you've watched markets for almost 2 decades, so you've seen that a lot of times markets don't move because of data, but like really the behaviors of investors and how they feel about that data actually. So I'm curious to hear what are some of the most consistent behavioral mistakes that you've seen investors make over the years, even the smart professional fund managers.
Yeah, I mean it's spot on, Ignacio. You know that we have seen so many stories about even the biggest investors losing big. So yes, I think that even big investors make the mistakes. To answer your question, I mean, how can we learn from these things, or how do you avoid some of these things? The short answer is that sometimes you can't avoid. I think, I mean, I'll be brutally honest. I think there will always be something that you could get wrong, even with your best of understanding. And therefore, I keep talking about that you have to be so careful about size and so careful about what durations you're putting on,
Mhm.
because you almost say that, well, I have looked at everything, but there's still something an unknown which might come from somewhere, and I have to be humble enough to understand that that may happen. But that doesn't mean it just changes me as a person. It's one of those things that is going to make me wiser. It just makes me a better investor. And trust me, if somebody came and told me I have never lost money, I would not give them a single penny to manage.
Me neither.
Right? So I think that mistakes, understanding that mistakes will happen sets you free, that you don't self-flagellate that you made a mistake, so you can't make this, because that eats into your confidence. Sometimes it's not your mistake. I mean, like, it's a mistake on portfolio, but it's not your mistake in the sense that there's nothing wrong with your process. But investment is art, it's not science, so things will go wrong. And the only way you can protect yourself is to size the trades correctly and take feedback from something is happening or happened in the past. Then you use that as a lesson to understand, well, it may happen or things are going to happen. One thing I've seen consistently in the market is that the herd mentality and the herd behavior, again, behavioral finance, is extremely strong, extremely strong. So when something gets sold down, there is no limit to how much it can sell more. So if you're doing risk management and if you're sitting on something which is 20% loss, you can be sure it can be 50% loss, I can tell you. Because when the herd takes over, they don't look at valuation. So when you're looking at your position, if you really want to sell something because the story has changed, sell it. Don't try to think that, oh, it'll sell only 10% and then buyers will come in. No, no,
Mhm.
no. I think that it could be sold down to like big, big and deep levels. So when you take that as a feedback, you avoid losses. So if the story has changed, sell it. Even if you have minus 10%, sell it. But you could be selling at minus 50% and regretting that you didn't take your own advice right at the beginning. Admit you got it wrong. Story has changed. You need to be out of this. Sell it.
I have a question. You talking about story, because it's one of the things I'd like to get better at in 2025. Storytelling.
Yeah. Yeah.
I think humans crave stories, but of course, in markets, narratives can often be a little bit misleading. So, how do you manage your own relationship with narratives? How do you think about storytelling, especially when some stories are kind of emotionally compelling but not analytically sound?
Correct. And I think that it's just from self, just training yourself. I mean, that's what I have done. I always say that as a portfolio manager, your job is not to say what should happen, but what is going to happen. Because we always get caught in what should happen. So we'll say, oh, this person should not be prime minister, that should not be office, they should not put this tariff, you should have this equality, you should have that. Most of the time, you are just imposing your own views. You're
Mhm.
really not looking at what is happening in the market or what other market participants are going to do. So I always get out of this trap of what should happen. Should is your idealistic view. It's never going to happen. We should just care about what is going to happen in the market and how it is positioned. So when people say market is wrong, I take an issue with that, because I think market is full of market participants. They're making their decisions and they're taking a view based on that. So I would say that having this understanding of how things work around you, looking at how markets behave, and of course, one important point, Ignacio, is that the market structure keeps on changing. So when you have a lot of ETF, and if you're doing single stock, you know that your single stocks are going to come in for pummeling if something was to go wrong, because a lot of flow is going to sell it. I mean, you saw with the GDP number, the first reaction to GDP, Q1 GDP was everyone to sell. And then people start looking at the data. So now you have to deal with algos, you have to deal with ETFs. So understanding the market structure again comes down to liquidity is very important. Your good stocks could be sold by 10%. Well, it's happening. $1 trillion companies are falling by 10% in a day, which was not the case before. So understanding that it's a market structure, not something wrong with your thesis, is very important. So you can hold your trade or you can buy into that trade and not just discard your trade. Oh, it's down 20. I need to get out of it. Out of the 2015 could be just driven by liquidity and flow algos. You have no control over that. And so when they read or people read and make decisions, you could be up 15% on that. And then you don't pat your back and say, oh, I made 30% on this trade. A lot of that could be because of liquidity. So have the humility to take as much credit that you should, but also at the same time, don't let that discourage you if something was to go wrong on the negative side.
Very good answer. Manish, we're getting close to the end of the conversation. Wow. I mean, there's so many amazing insights that you've been sharing today. I'm sure like all of our listeners are loving this conversation, but I'd like to ask you one last question.
Sure.
A question about the next generation, really. What's one piece of advice that you'd give to young investors, to future CIOs, to all those young lads that are entering the finance industry today? Something that you wish you had learned earlier in your career and that you think it's really important?
I think it's very simple. As a fall in love with the process, not the outcome. Because when you are outcome based, you will judge yourself, you will call yourself, I'm not doing very well, I'm not, because you're just focused on the outcome. You're focused on this bigger thing which might come down the line. But when you fall in love with the process, by which I mean, when you wake up, you get excited about a piece of news. You go and read that in different journals, different things. When I do my research, it's like going through different thing. I can go to different website, go to research website, go to US based Princeton library to get a document from there on Plaza Accord. Fall in love with the. I wrote a post on Plaza Accord today, and I looked at so what happened? Who was the treasury secretary? So it was Don Regan, and then replaced by James Baker, and James Baker was in favor of intervention. Don Regan was not in favor of intervention. So when you do all these things, the process, that's the exciting bit. Like you're excited every day. I always think that I'm doing the best job that I could ever do, and I'm getting paid for it, which is excellent, right? This is something that I would do anyway. Like this is true. My mom called me many years ago, and she said, and like she went to high school, not to university, and she said, Manish, what do you do? I know you come on television, people like you, you have a good job. What do you do? And I said, and this was my thing to get back to her about newspapers. I said, Mom, I read newspapers and I get paid for it. And she started laughing. I said, Mom, that's true. That's absolutely true. That's what I do. I read news. And my mom was saying, oh, the newspaper, you've always read that since your childhood. So I would say that fall in love with the process. Don't fall in love with the outcome. Because when you fall in love with the outcome, you judge yourself, you let others judge you. And that is never a happy process because you have no control on that. What you are doing, you are in control. You have excitement of that, reading things, visiting places, doing things. So I would say fall in love with the process, not the outcome.
That's a really good one. I feel it applies to so many things in life, like the journey, not the end result. And
Yeah.
I think it's a great way to finish this conversation. I love the quote about you being paid for reading newspapers. I argue that's only a part of the job, but it's a
Yeah.
good one. I'll use that one with my mom whenever she asks me next. Manish, it's been absolutely amazing to have you on the show. Thank you so much for your time. For all those valuable insights. I think you really came across as a very savvy investor, and those values that you were preaching for, humility and diligence, really came through this conversation. So thank you for that. And I hope the upcoming years are as good in terms of performance, but also in terms of enjoyment for you and your future business ventures.
Thank you very much, Ignacio. I really enjoyed this chat. Very comfortable and easy chat. And I highly recommend other people to come on this chat and share their knowledge.
Thank you. The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.